This is going to be an interesting class. So for those of you who are wondering why I'm acting the way I'm acting, my monitor is literally blinking right now, not showing anything. So I'm having to look over my shoulder and run the computer like that, and it's hell in the neck right now, but it's a problem with getting old. So I'm going to do my best to run this. The good news is I've done this lecture many times before. I think I know where we're going to be, but we'll see if my actions can line up with my words, and that's going to be the goal. All right. So yeah, today we're going to be talking about chapter 3, part 2. So before we started, something interesting came up, and we'll be talking about this a little bit later on the course. As I mentioned, remember I talked about the Hulu series, or the Hulu show, Scam Goddess. So that was about Rita Crundwell, who will come up a little bit later. Professor Deers, or Dr. Deers, came by my office, and it turns out that there was a recent piece of news that she was her sentence was commuted by former President Biden right before one of his last acts of office, and so this drama just keeps getting deeper and deeper. I'm not sure. We may have to go into a much deeper rabbit hole than we would normally go into to talk about this, but it gets more fascinating. We're not quite there yet, though. We still got a few more chapters to go before we get to that one, and an exam to go through. But that's not till week 5, so we will wait off on that. Today we're going to talk about one of my favorite things to talk about. We're going to talk about materiality. Let's just go ahead and get started. Again, I'm going to have to look over my shoulder for some of the materials because, like, normally I have this in front of me, but because my computer is constantly entering power save mode, I'm just there. No, all right. It was so worth a shot. All right, yeah. I'm going to do my best, but this may be a little bit dicey to try to figure out everything that I need to coordinate and wrangle on my end. So start out with this. So back in the first lecture, what did I say about the concept of reasonable assurance? Now, with respect to this, I compared it to some other concept. All right, I said reasonable assurance is what we strive for in auditing, but wouldn't it be better if we had something else? What was that term? Does anybody remember that I talked about? So I said reasonable assurance, but then I contrasted that to absolute assurance. All right. And I said reasonable assurance is what's possible. Why don't we go for absolute assurance? And we basically said absolute assurance is not possible. It's impossible to do. Remember, I said if you wanted to get an A in this course, an absolute assurance of an A, you'd have to study day and night every single day for the rest of the semester. You have to forsake all your other classes, okay? So those of you enrolled in tax, you have to tell Dr. Caden, I'm sorry, auditing's more important, okay? You'd have to just basically go through this whole rigmarole to try to get there. And even then, you probably wouldn't get to absolute. You'd get close, but not to absolute. So absolute assurance is effectively not something that we can accomplish as much as we might like to. So that leaves a reasonable assurance, which means that all our procedures are designed to obtain reasonable assurance. And now that's what this statement says, right? An auditor designs audit to provide reasonable assurance in detecting misstatements that are of sufficient magnitude to affect the judgment of reasonable financial statement users. So we don't find all errors. We don't find all misstatements. We find the ones that we believe are material, and we address those. So materiality is going to be assessed in terms of the potential effect of misstatement decisions made by a reasonable user of the financial statements, okay? Now, this is actually reflected in the standard unqualified audit report, and this is actually unmodified unqualified report. The wording is very similar. It says, the financial statements present fairly in all material respects the financial position of the company. So they're not saying the financial statements are guaranteed accurate. They're not saying the financial statements are 100% accurate. They're saying the financial statements are close enough. They're close enough to what you were expecting. That would be really awkward if we change the wording on the audit report saying it's close enough. You know, that might get a little bit of suspicion. The people who use the financial statements might say close enough. I'm not comfortable with that. So instead of saying close enough, we say in all material respects. So it's just kind of a way of saying the same thing, but saying it more fancy, more complex. It's a little bit like you go to a fancy party. You're not going to say, well, this is great grub. You're going to say, this is divine food, right? So that's the fancy way of saying close enough. Fancy way of saying close enough. Thought I'd get a bit of reaction out of that. Most people are just like saying, be serious, Dr. Barnes, be serious. All right. So materiality. Materiality, an important part of audit planning is to determine overall materialities for the financial statements, which we're going to call planning materiality, and then decide on tolerable misstatement for significant accounts and disclosures. Now, this sounds fairly intuitive, and for the most part, it starts out fairly intuitive. it starts running off the rails really, really quickly though. So as we start moving through this, it's going to get very, very complex, and it's going to get disorienting. The important thing is if you don't understand what I'm talking about something, please raise your hand and say, all right, can you clarify what you mean by that? I'm going to try to go through it as slow as possible, point by point, but it does get complicated very quickly. So first goal, we're going to say, let's determine overall materiality for the audit. That's going to be actually pretty straightforward. We're going to have some tweaks, some modifications that we might want to make to that. We'll try to figure out what those are. Once we get to that point, we figure that out, then we're actually going to determine tolerable misstatement. Tolerable misstatement is nightmarish, okay? It is a bit of a challenge. Again, we're going to go through it slow, piece by piece, but you do need to pay close attention to this. Then we're going to determine, based on our findings, whether the financial statements are misstated. And the idea behind this is we're going to compare our findings from our testing to our materiality amounts. And if our findings, if the misstatements from our findings are less than what we can apply, we can say the financial statements are free from material misstatement. If we find in our audit testing that there's a problem, that there's larger misstatements than what we can tolerate or what we plan for, that's where we have issues. But we'll get to that here shortly. All right, plighting materiality. Plighting materiality is the maximum amount by which the auditor believes the financial statements could be misstated and still not affect the decisions of users. We talked about this concept last week, not a few weeks ago. There's only been 2 weeks in the class. Talked about this concept last week. All right. Remember, we talked about $1 million. I said, is $1 million material? And everybody replied with the proper accounting treatment. Okay. What was that statement? It depends. Okay. It depends on what the nature of the client is. If we talked about the nature of the client being Greek Corner Euros, $1 million would by far be a material misstatement. Okay. If we say Walmart, they would say that's not even close to being close to material. So we'd say if we say the misstatement will not affect the decision of the users, then we say that is not a material misstatement. Now, the interesting thing about materiality is that auditing standards require the auditor to establish a materiality amount for the financial statements as a whole. This is something that we are required to do for an audit engagement. The issue with that is that the standards don't tell us how to do it. They say it's an inherently subjective process. You just have to be consistent in your application of criteria. So no specific guidance on how to determine materiality, just say you have to do it, which that's really frustrating to me. It'd be kind of like saying, all right, guys, study for the test. What do we need to study? Just do your best, all right? That would probably frustrate a lot of people in this room if I said that stuff. Fortunately, that's not the way I approach the exams. So hopefully that'll be good for everyone involved. So let's go ahead and talk about what auditors traditionally do with respect to materiality and how they approach materiality. So first of all, we're going to start with quantitative analysis. We're going to start with quantitative benchmarks. These are going to be amounts that we're going to use to determine what we should use as our basis for materiality. Now, you can kind of see up here, we've got a few that are listed. Our usual one that we start with is going to be the first one, income before income taxes. Now, it says loss in parentheses. I will say if it's a loss, we generally will not use that account because that's a negative number. And it's very, very hard to audit in terms of negative numbers because then you have to basically find every misstatement that exists. So usually it's going to be pre-tax income. We could also use the basis of total assets, total revenues, net assets, total equity. Now, the question is going to come up, well, is that a basis? Does that mean that's the amount that we use? And the answer is no. Usually we're going to use some percentage of that amount. In fact, we'll see when we get to our next slide, our general guideline, our rule of thumb, as the idiom goes, will be 5% of pre-tax income. So 5% of pre-tax income will be our general guideline. Now we'll talk about reasons why that might change. But for the most part, we're going to say this is our quantitative basis. And we might change that quantitative basis based on certain factors, but we'll settle on whatever the base is going to be. So we'll say for default, we're going to use pre-tax income, and we're going to use 5% of pre-tax income. That's going to be our basis for materiality. We're not done, unfortunately, though. We're not done because then we can start to think about reasons that we might want to use a lower percentage. Not very often a higher percentage, though it can occur situationally, but for most parts, why we might make that percentage lower. That's when we start getting into qualitative factors. Qualitative factors generally represent risks that are present in the audit. And if risks are present, then that might mean that we have to do more work to identify the presence of such risks. So some examples of this, if we've audited a client or we're going to a client that we have audited information on, and they've had material misstatements in prior years, we might say, that seems to be a risk to me. I probably want to use a lower percentage of materiality, which would be a lower materiality amount. If there's a high risk of fraud, if we think that there may be fraud occurring in the company, we may say that risk is going to define that we need to use a smaller materiality amount. Potential loan covenant violations. If small amounts may cause the entity miss forecasted revenues or earnings or affect the trend of earnings. So example of this, you've got a really large company that barely had a profit in the current period. So if that's the case, that might be something that's really problematic if we try to do that, because if they barely made profit, then any misstatement they have could change that from being a profitable year to a loss, or to a year of a loss. The reason I mentioned that actually will come up in your homework assignment for Friday, so it's something you want to keep an eye out for. Or the entity operates in a volatile business environment, has complex operations, or operates in a highly regulated industry. So just to summarize what this slide is telling us, it's saying that, first of all, we're going to establish what is our benchmark for materiality. What is going to be the basis we use to calculate materiality? As I said, many times we're going to say pre-tax income. That'll be our default. We're going to talk about that here in just a second. And then we're going to say our default will involve using a percentage that we'll have assigned to that. So we'll usually kind of use our rule of 5% of pre-tax income. Then we'll ask a whole bunch of questions about the client. And we're going to say, do we think this risk is present with the client? And if so, we may change that percentage from 5% to 4% to 3% and lower amounts to reflect the risk that's present with the client. So that's basically what the slide is reflecting here. This is a really important slide to be for reference to this concept, because this covers both aspects, both quantitative and qualitative aspects of materiality. Now, going forward, for our private and public and private, which are going to be profit-oriented companies, our general rule will be income before tax, 5% of income before taxes, okay? And this will be the guideline that we use in all of those scenarios. Now, in most of those scenarios. Now, you'll notice that we got some benchmarks up there. There's some ranges that you can use. I will kind of give you some guidelines on which range to apply, but for the most part, all you need to keep in mind is if you're falling within the range and can justify your benchmark, then it should be fine, okay? I'm not going to get critical. So like, for example, when we start talking about how you would calculate materiality for some of your homework assignments, as long as you use good judgment and can apply that judgment and justification to your position, you should be okay. The issue comes in when we start making quantitative adjustments. And what I mean by that is we have to think about something other than income before taxes. So a real easy example is not-for-profit company. Would it be appropriate to use income before taxes for a company whose whole sole purpose is not generating income? All right. By definition, they're a not-for-profit company. It's probably not good to use profit as a basis for materiality. So if that's the case, we're going to use total revenues or total assets. What about asset-based entities? You guys have heard of mutual funds, you know, those big companies that do investing. What kind of returns do you usually get on those investments if you're the company? Really, really small ones. You have to have massive amounts of assets to generate very, very marginal returns for the organization, because it's usually a percentage, because you're generating a return for the assets of the client, but you get a small percentage of their percentage. So usually large amounts of assets to return marginal amounts of revenues. So if you're using income, it's probably not representative of the organization's assets as a whole. So in that case, we probably want to use total assets or net assets. Those are some examples of when we use a different quantitative base. So it's important to keep that in mind, that we won't always use pre-tax income. There's also some scenarios where, for example, if a company has a loss or they've got volatile earnings, we may say that a different basis might be appropriate. Again, the goal here is to be able to justify your position and justify it based on the circumstances present. I will say in most of the scenarios, for simplicity, we'll probably use that default rule of thumb, 5% of pre-tax income. But that scenario can change based on different guidelines. And we'll look at some of those when we get to homework on Wednesday. All right, so just as a quick, quick recap. Let's say I'm a profit-oriented company. Doesn't really matter if I'm private or public, okay? I have $1 million of pre-tax income. What would be the materiality, absent any other considerations? What would be my quantitative basis for materiality? 5% of $1 million would be $50,000, I think. Just math off the top of my head. And I can't even use the computer for the calculator here. So I obviously got to trust you guys. So $50,000, all right? So that is going to be our planning materiality, the planned materiality for the audit or financial statement as a whole. Now, the good news is that's a small amount. We're going to be dealing with much larger amounts in our examples. but it becomes a little bit more challenging when we start talking about how do we consider materiality at the tolerable or the account level, the account of disclosure level, which is tolerable misstatements. All right. Hopefully you guys have a good grasp on everything we've talked about so far, because again, here's where everything starts getting really, really fuzzy. Here's where things get fuzzy. So everybody good so far? Anything that I need to reiterate? All right, let's move forward. Let's talk about tolerable misstatement. Tolerable misstatement is intended to establish a scope of audit procedures for individual accounts, okay? So there's a few important things to note about tolerable misstatement. Auditors generally set maximum tolerable misstatement for a single account between 50% and 75% of planning materiality. Now, this is really confusing, and I'll explain why it's an example of why it's confusing. Generally speaking, we're going to say, what is the percentage amount? So we'll say 50%. All right, we'll say 50%. That means the amount that I can set for tolerable misstatement for any one account, the maximum amount I can say is 50% of what our materiality is. So I'm going to say my planning materiality, I'm going to go to a nice round number, is $100,000. All right. If I'm going through and assigning tolerable misstatement to each account, the most that I can use for any one account is $50,000. 50% of planning materiality. Now, it's important to remember, this does not mean that I have to use $50,000 for every single account. Okay, if I have an account that has a balance of $2,000, it would be silly to assign materiality of $50,000. Says, okay, $2,000 in the accounts and misstated by as much as $50,000. I'm comfortable with that. That would be ridiculous. Okay, that would be ridiculous. So that's really important to remember. Now, the reason I think that this is really, really hard to remember is that we assign a percentage and we stick with that percentage. It says between a range, which can get really confusing, but that range is basically saying we're going to usually identify a percentage and say that's the percentage threshold that we're going to use for this audit, and that percentage will not change. The reason that gets confusing is several years ago, back with edition number 9 of the textbook that we're using, they had a materiality workbook that was beautiful. It worked out really, really well. And then some editors came in and started reading the material that was put up here and said, oh, a range of 50 or 75%. And one of the editors said, I'm going to fix this because this materiality workbook is wrong. And they tried to set every single account in the materiality workbook between 50 and 75%. So instead of saying we're going to set arbitrary amounts, or they're going to say everything has to be between 50 and 75%. And it got really, really dicey really, really quickly because the amounts were really, really large in the materiality workbook. And so I actually talked to McGraw-Hill. I talked to a representative. I say, yeah, this is wrong. Whoever edited this and made these changes, they don't know what they're doing. And then they argued with me. And I was like, okay, well, you know, I'm not gonna change your mind on this. But the version of the workbook that you all have on Brightspace is the one that I want you to use. If you go and download the one that's on Connect and use that workbook, it's significantly different. You'll see why it's substantially different. It's kind of an interesting exchange. This is not saying that every account has to be between 50 and 75%. This is saying that the maximum amount that you assign to one account is going to be some amount, which that amount is predetermined. It's going to be something between 50 to 75% of materiality. So we're going to establish that up front, and we'll look at an example of that here shortly. Then the next one, that was the first confusing thing, but it doesn't stop there, okay? Second one is going to be firms generally cap the size of aggregate tolerable misstatement for all accounts to 3 to 4 times planning materiality. So if I assign a tolerable misstatement to every single one of my accounts, okay, I do it, and we'll talk about the judgment that's involved in that, but I assign that, and then I go on and add all those amounts together. That amount should be somewhere between 3 to 4 times my total planning materiality. Now, think about what I just said. I said the maximum amount that I can misstate in a given account, if I add all those maximum amounts together, I could accept it being 3 to 4 times larger than my overall misstatement for the financial statements. Does that sound contradictory to anybody in the room? If you think about it, you're probably like saying, okay, if you think about it, you're like saying, this doesn't make any sense. Dr. Barnes has finally lost it. And it's certainly possible, but I'm certain about this, okay? Certain about this. Why can it be up to 3 to 4 times larger? And the answer is, I do not expect every single one of my accounts to be misstated by the maximum amount. I'm going to assign an amount that I could expect an account to be misstated by and still be okay with. But if every single account is misstated, I've got problems already. I would hope that most of the accounts that my clients are going to give me are going to be correctly stated, at least very, very small misstatements. So it's very unlikely that I'm going to see material misstatements in every single account, which is why we can use 3 to 4 times material planning materiality. And we'll see examples of this here in just a second. All right. So here's where things kind of get a little bit fuzzy. All right. At the account level, the lower tolerable misstatement is, the more extensive the required audit testing is. So if I make my numbers for tolerable misstatements really, really small, I have to do a lot more test work. So logically speaking, if I'm an accountant who's trying to avoid doing excessive amounts of work, what do I want to do? Do I want to make tolerable misstatements smaller or larger? Larger, okay? As large as I possibly can, given the size of account that's reasonable for the account. Let's think about what the logic behind this is. They assign tolerable statements strategically to control the necessary testing of individual accounts while still retaining planning materiality. All right. So my analogy is planning a family dinner. Did anybody have holiday meals like over Thanksgiving or Christmas with families? Okay. So make those holiday meals and you're just kind of like, okay, this should be sufficient a meal for everybody. So my family is fairly small when we have our holiday dinner. There's me, and I enjoy a good meal. Okay. I enjoy having a good meal. We got my brother who's roughly my size. He doesn't eat nearly as much as I do. Let's say probably maybe like 3/4 as much as I do. Got my sister-in-law. My sister-in-law is basically half my size and eats twice as much as I do. She's got a ridiculous metabolism. It's unreal. Okay. We've got my mother. My mother she's like 5'4". She's like maybe 120 pounds soaking wet. Okay. She eats like 5 bites and she's like, I'm so full. That was such a good meal. It's like, you barely touched anything. All right. Unless it's dessert. She loves dessert. All right. So then we got my nieces. And for some reason, I don't know how, they must have like a charge center to the core of the earth, and that charges them. They can eat 0 food and still have infinite energy. I'm not sure how that works. Okay. So if I take any one of those individuals and say, I'm going to use that person as a basis for how I'm going to plan my dinner. So I say, I'm going to take the amount that Michael eats. That's my name, by the way. Michael eats, and multiply that times 6. And that's how much food we'll have for the family. That's way too much food. Okay. Way too much food, because I'm going to eat more than the average person. If we took it times the amount that my mother ate, okay, and multiply that times 6, we'd have enough food for one person. Okay. Well, maybe 1.5, because my mother would be able to finish her meal. But yeah, you can't basically use one individual and justify the whole. You've got to do an assignment for every single person. You have to think about what every single person could eat. Even then, we still have usually way too much food at holiday dinner, but we try our best. Okay, we try our best. Okay, so let's go ahead. I didn't open this up, so I'm going to have to look back here. I want to take a look at the materiality workbook. This is going to give you an insight as what your assignment is going to be for this Friday. This is what I told you guys, that it's very, very challenging. It's very confusing. You're going to get to the second tab and you're going to be like, I have no idea what's going on. You're not going to be alone. You're going to be like every other student that's ever done this exercise. This is heavily subjective, okay? There are no right or wrong answers. In fact, I've done this now, I guess we're going on almost 20 times doing this in a class. I will tell you right now that the answers that I'm going to put up there are not going to be the same answers as what the answer key is from the workbook. The goal here is to be able to justify your position and to be able to make sure that you have a deeper understanding of how we actually apply this information. So let's go ahead and look at the information here. So you notice that we start out on this work paper, and this is the easy part. This is planning materiality. All right. Now, what did we say our rule of thumb is for planning materiality when we assign planning materiality? So our base is going to be pre-tax income. Okay. What was the percentage? 5%. Okay. So we could actually just go ahead and say, let's use a measurement base. I cannot read from this direction. It's so hard. Okay. This is pre-tax income. Okay, good. I'll rely on it. And then I'm going to put a 5 in here. All right. Now, here's the deal, by the way. You can't just do this right now and say, well, that's Dr. Barnes put in for the example. I'm just doing this as a shortcut. You will need to justify your answer to this. Part of the reason for doing this, you'll have to read through the materiality work papers and determine, is 5% for pre-tax income sufficient given what we know from the materiality work papers. So you'll have to do some justification for this point, but for simplicity purposes, let's just go ahead and say this is okay. All right. For our purposes of using this, what this means is, I'm going to move away so I can actually see the screen. So we've got a measurement base. This is our pre-tax income, $70 million. 5% of that means we got a planning materiality of 3.5 million. That means that there could be misstatements of up to $3.5 million over the entire audit, and we'd still be able to accept that it was not materially misstated. All right, that's what this justification means. This is the easy part. It's not meant to be fooling or confusing. All you need to do is just make sure you can justify your position. One thing I'm going to tell you right now is, one of the things I said in the assignment is to read through the materiality work papers. It's only 2 pages. It won't take you really long, but there's some really big clues and some tips about how to actually apply materiality in these scenarios. So make sure you look at that. And that would be a big clue, a few clues in there. But yeah, when I say justification, you actually have to provide some justification down here in these yellow boxes right here as part of the assignments, which we're not going to do now because not only do we are limited on time, but I don't think I could type from this direction. That would just be weird. All right, so let's move on to this difficult part. Here's the challenge, all right? You will notice that we've got a whole bunch of accounts here. Some of these have got yellow, which means these are ones you're going to fill in, all right? So you're going to be assigning tolerable misstatement. Now, there's a few things we need to know about tolerable misstatement. First of all, we established that tolerable misstatement is going to be a maximum, a percentage of planning materiality. If you look in the materiality work papers, I'm going to spoil it for you. Willis and Adams, which is our auditor, the firm that we work for, they use 75% as a maximum tolerable misstatement, okay? So 75%, can somebody do 75% times 3.5 million? It's like 2.3 million or something like that, I think. But to clarify that my number is correct, something around 2.3 million, 75% of that, maybe a slightly larger, 2.5 million maybe. So yeah, what this means is that if we're setting planning materiality at 3.5 million, the maximum we can assign for tolerable misstatement to any one account is roughly about 2.5 million, okay? And I'm estimating here because I don't have access to the calculator. So we're going to go through here, we're going to determine what can we assign for tolerable misstatement. Now, again, we can't just arbitrarily say 2.5 million, 2.5 million, 2.5 million, 2.5 million, 2.5 million. That doesn't work that way. That's not the way that this works. The idea is that's the highest we can do. That's the highest we can do for any one account. And some accounts we will want to set that to. You will notice inventory is about 2,300,000. That's pretty close to our maximum. Sounds right? Is that correct? Pretty close to our maximum. What is the nature of this company? You guys had to do an engage acceptance exercise for your discussion. What is the nature of Earthware Clothiers? They're a service firm. They're a restaurant. They're a clothing company, okay? Inventory is one of their really, really important accounts, which is why this is such a large account and so prominent. We're probably going to set a very, very large amount for that particular account because it is such a big deal, okay? So what we're going to continue on is we're going to think about some of the factors that are going to go into this. Now in the slide, I kind of demurred from the slide, but let me go back to the slides. One of the last things I said at the bottom of the slide is the auditor considers the size, activity, complexity, and risk of an account relative to other accounts and allocating tolerable misstatement. So what you're going to do is you're going to look at the account and you're going to say, what is the amount that I want to set for this account? And we're going to think about aspects of this account. So I'm going to give you a few spoilers on these to help you along your way. You can actually read some of the explanations that are provided for other ones that will help you in guidance on this. But let's do something like cash. What do we say? Cash, relatively large account, so size is there, okay? Can we say it's got a pretty good size on it? It's not the largest account by far. It's going to be smaller than inventory and certainly smaller than PP&E, but about $80 million, so it's got good size. What about activity? Do you think there's a lot of activity in a cash account based on your experience in accounting? Probably so, okay, good activity. What about complexity? Is cash complex? No, cash is simple. Cash is the most liquid asset. It is very simple. So if I asked you to tell me how much cash you personally have, could you do that pretty easily? I'm not going to ask you to do that, okay? I'm not going to do it myself, so I wouldn't ask you to do that. But if I were to hypothetically ask you to do that, could you determine that number without too much difficulty? Probably so. In auditing, cash is considered to be one of the easiest accounts to test. So even though this is a large account, we don't need to assign a lot of tolerable misstatement to this account because it's very unlikely we're going to have a significant misstatement. So I'm just going to set arbitrarily 500,000 here. Okay. You will notice that's far less than the 2.5 million threshold that I've set. And the reason is that even though it's got a lot of size and a lot of activity, it's very, very easy. It's not complex at all. Okay. And moreover, there are some risks associated with it, but we assume that the client has mitigated most of those risks. Okay. What about I don't want to do receivables because they don't receivables, but let's do I don't want to do that one. Okay, let's do intangibles. That's kind of a fun one, okay? I'm not intangibles, am I? Okay, not an intangible. There we go, intangibles. All right. What are your guys' impressions about intangibles? This is a large account? No, not at all. But interestingly, it does look like they have a significant change from one period to the next, which is something kind of worth noting. So that's kind of interesting. What about activity? Do intangibles usually have a lot of activity? Unless you're Dr. Eisen, the answer is no. Okay. Dr. Eisen, his middle name is intangible, by the way. Yeah. Anyway, Isaac Intangible Eisen. And then what about complexity? What about intangibles complexity? Are they complex accounts? Yes, intangibles are probably some of the most complex transactions you can have. Okay, so we don't have a lot of size, don't have a lot of activity. We do have some complexity here. We probably could set this maybe like 200,000. Now, what does that amount mean? You notice that I'm kind of looking at arbitrary numbers. And you say, what are these percentages? Do they have any bearing? The answer is no. It's a very subjective exercise. And if I can repeat this and had everybody assign arbitrary numbers, I would have roughly about 20, I don't like there's 23 people in this class, 24 different answers. That includes myself. Okay. The goal here is to understand what it is we're trying to accomplish this. We're trying to assign what we believe is appropriate for every account. If I was concerned that there's more complexity here than I've accounted for, I could set this to 300,000. I have control over the amount that I allocate for every single account. However, I am constrained by one factor. If you go down to the bottom, you will notice it says, here is the amount of planning materiality that we've currently got allocated. And then keep in mind, so this is the planning materiality. This is what we've got allocated. If you look at the guidelines, it said this should be no more than 4 times our planning materiality. Currently, we're at 1.9, so we're okay. But I still haven't filled in a whole bunch of boxes. I've got still about 6 boxes to fill in. By the time this is done, you want to get close to 4. As close to 4 as you can. Does anybody ever watch The Price is Right? You want to get as close to 4 without going over, okay? It's the Price is Right mechanism. Why? All right. Let's think about both perspectives. If I go over 4, I'm allocating too much planning or tolerable statement to an account. Remember, we said that 3 to 4 times is acceptable, but 4 is too much, okay? What if you just use really, really small amounts, okay? What if I just say I'm gonna use really small amounts in the remaining boxes, and I'm gonna keep my planning materiality at 2.5 times, or my tolerable statement, aggregate tolerable statements, it's gonna be 2.5 times planning materiality, okay? Then you're going to go to the partner and you say, I'm a genius. I set it at 2.5 times. It's much lower than this. What's your partner going to say? Yeah, we'd have to do a whole lot more work to check those. You basically set materiality so low that for every single account, you'd have to double your work or triple your work to make sure that those accounts are correct. So we want to set these numbers as large as possible, but we don't want to go over 4 times. That is the challenge. That is the goal that we're trying to get here. Okay. Now, that is basically what you're going to be doing. You're going to be justifying, you're putting those answers in, coming up with those numbers, getting close to 4, making that number. If you can make it 4.0, you might be a little bit over. You want to make it like 3.9. That would be the goal. If you can get to 3.9, then you're sure that it's not over 4. You also need to justify your answers. Some of these are going to be more complex accounts than others. I would use the dimensions that I talked about, size, activity, complexity, and risk, to justify your position for each of these accounts. But I've given you a couple already. All you need to do is fill in the rest. All right. So what do you guys think? Pretty straightforward, clear as mud? Clear as mud? Yeah, it's good. Trust me when I say it's not a difficult assignment, but you will feel like you're not really having a good justification of position. Like, I don't know what I'm doing. And again, like I said, don't feel bad about it. Once we're done on Friday, you still won't feel like you knew what you were doing. Okay. Once we've done reviewing on Friday. All right, let's get back to the slides. All right, so here's the deal. We're going to jump forward. We're going to hyperleap in time. I know we've not done any testing or talked about the testing process, but at some point in the audit, we're going to perform testing. And we're going to test all of these accounts, and we're going to see, all right, this account is correctly stated. This account is misstated by $1,000. We're going to come up with conclusions for every account that we're going to test. For the most part, there may be some scenarios that we don't test an account because it's a really small account. And we may say there's no reason to test account because the account is immaterial. If the account has like a balance of $50, there's no reason to test that $50. It's kind of ridiculous, okay? But for the most part, we're going to say we believe the account balance, or we believe the account's balance is correctly stated, or it's misstated by certain amounts. We're going to take every single one of those misstatements we identify through our testing, and we're going to add them together. And then we're going to compare them to our planning materiality, okay? The planning materiality is going to come up. Now, it's important to note, basically, we can actually change planning or materiality assessments over the course of the audit. It doesn't happen frequently, but if for some reason we get information, we believe that we've misassessed the materiality amounts, we can change our assessment of materiality, both planning materiality and tolerable misstatement, throughout the course of the audit. For the purpose of this course, we will not do that because that adds a substantial layer of complexity, but it's important to note that that's possible to do in an actual audit. So we're going to aggregate all of our misstatements and get from each account a disclosure. And what are we going to do? We're going to compare those aggregate misstatements. These are the actual misstatements we identify over the course of testing to our overall materiality. And then we're going to say, if the aggregate misstatement is less than the overall materiality, we conclude the financial statements are fairly presented. So remember in our example we just looked at, I said planning materiality with $3.5 million. If I look at all of my total misstatements for my testing over the course of the audit, which we're going to learn how to do over the course of the semester, and I say the sum of all these misstatements is less than 3.5 million, it's fair for me to say the financial statements are free from material misstatement. Does everybody see why? The actual misstatements are less than what we can tolerate within our planning materiality. On the other hand, if I do the testing, okay, and I say, all right, they've got an inventory misstatement of $5 million, which is greater than that 3.5 million that we identified earlier. What would be the logical scenario then when we go to the client? We'd say, to go to the client, say, client, okay, your inventory is misstated by $5 million. This is a material misstatement. You have one of two choices. The first of these is you can make an adjustment to inventory for $5 million to make sure it's correctly stated. The other possibility is they say, no, we refuse to do that. And then we do our second scenario where we issue a bad opinion. Remember those opinions we talked about in chapter 1 and 2? Yeah, that's going to be the problems when we have misstatements. That would be the scenario that we'd be encountering. So in this scenario, we're comparing to planning materiality. Now, I do want to make a note here. It is also possible that we could have our misstatements less than planning materiality and still require a restatement or adjustments. This would come up if we look at an individual account and it's misstated by an amount greater than our tolerable misstatement in that account. So everything looks good except for one account, but that one account is misstated by a really large amount, which is greater than tolerable misstatement. Even though that account or that amount does not represent a great amount greater than planning materiality, if it's greater than the amount of tolerable misstatement in that individual account, we would still say you need to make an adjustment to this account. All right, so we do have to consider both planning materiality and tolerable misstatement. So planning materiality would be some of our aggregate misstatements in a whole. Tolerable misstatement would be the misstatement in that individual account, which again, we'll get some experience of that as we do work through the homework. All right, any questions on that? Again, really, really clear. All these dynamics in play and everybody just got it because of my excellent teaching over my shoulder, right, like that. Yeah, all right. We have a discussion to go through, so let's go ahead and talk about this. So basically what we're doing is Wilson, Adams, and CPA are the current auditors for EWC. We're going to be actually determining whether or not we want to continue with this client. So I ask you three pretty basic questions, and some of these are a little bit more straightforward than others. All right, so what you had to do is you had to review some of the information that I provided. I provided you with a little bit of some background information. There was the background document. There's the annual report, which is in the textbook and should be able to identify in the textbook, but it is elusive sometimes. It actually is in electronic versions. It's sometimes not in the paper versions. And then I also gave you a client's continuous case file, which is another working paper that we could have gone through in this course, but I don't think that it's as important. What I would rather do than go through that Excel file is answer some questions. We want to actually determine, is this a client we want to continue on with? So let's answer the first couple of questions to start. All right. In your review, you looked at this company and you looked at the nature of earthware, and you know that they're a retail inventory company and they've been in business for quite a while. We've been their auditor for quite a while. If you look at the information of the auditor, they've been the auditor since 1975. So that's almost as old as I am. Not quite, but almost as old as I am. It's a long tenure, all right? And over the course of the proceedings, they've kind of adapted. It looks like their business model is a little bit antiquated. Keep in mind that this is a business model that was created when the textbook was created in the late 90s. This is like a kind of a LL Bean lands in type thing. There may be threats in the environment that may be relevant here that we have to consider. But as a general question, I ask you, are there any business risks the auditor should consider as part of its decision? What do you guys think? We've got some very general risks and some very, very specific risks. So let's talk about some general risks. The industry and its environment. Would we say the nature of this industry is not susceptible to much change, or would you say it's competitive, susceptible to a lot of change? Competitive, yeah. Competitive, susceptible to a lot of change, okay? So they've got a lot of existing competitors in the industry. And there's kind of new entrants that are occurring all the time. This is something I always bring up because when I started teaching this class, it was back in 2015. And I thought it was amazing that they didn't talk about like Amazon and Walmart online and Target online as some of their competitors. Those would be the ones I'd be really, really thoroughly worried about. Not like LL Bean and the other companies that are catalog retailers, but the ones that can actually provide much better online services. That being said, that is definitely a threat we can identify. So overall, this is a really important one, and keep in mind that we will talk about this in a little bit more detail when we start talking about risk assessment. We get to risk assessment in chapter 4, which will be next week. We're going to talk about the industry and its environment and the conditions they operate in. The reason for this is because we already know what responses to risks are. We've got to be able to know what the risks are present. So we're going to reiterate this point. We're going to talk a little bit more about the nature of their industry. But at a basic level, we can say that this is a competitive industry with subject to change. So that's a risky environment. Let's talk more about the organization specifically, okay? Were there any risk factors you identified in the earthware background documents that you might want to bring up that might be relevant?
The recent chief accounting officer meeting.
Right. All right. So yeah, the I think it's controller, and there's got a new controller. I believe it's so Brad Norton, was that the name of the guy who was departing? And then they've got I'm not even looking at notes here. I'm just remembering these from my own memory. It's like Carol McKay, I think that was her name. Okay. That's 10 years, guys, 10 years to teach them the course. Yeah. Carol McKay came in. What was the consensus around Carol McKay? What did people think about her?
Wasn't like her credentials weren't very good. Like people were wondering about her ability to do the job.
Her experience, she's experienced, but her experience doesn't necessarily line up with the position. Okay. So there was some concern about management and even the auditor that she may not be qualified for this position. Now, this is not an indictment against Carol McKay. She's not saying she's a fraudster, just saying like she's not really controller. She doesn't really have the background for a controller position. Now, what are your thoughts about that as the auditor? Is that a risk? Certainly problematic when a controller gets up and leaves and we've got a new controller who doesn't know how to do the job. All right. So that's something to keep in mind. Anything else you identified in there is where background reading materials.
Changing accounting systems and how it's like on a couple quarters to the things.
Yeah, so this was previous year, but they did have a change in the AIS and the reporting system. And we can justify say this was a needed change in AIS, as many of them are. But did it go smoothly? No, for the first couple of quarters, there were some problems with it. And they think that they've got everything worked out moving into the current year. But it's something we probably should be aware of, right? All right. So yeah, I think that that's pretty good. And those are actually the 3 items that we talked about with the nature of the organization that's detailed in the document. Now, I did have you do a little bit more digging, okay? And I asked you a question. I wanted to see how far in depth you guys went into. So there's one that's kind of elusive here. Are there any incidents that might suggest an issue with management integrity?
VP of finance betting on college basketball.
Yeah, we had a VP of finance who was gambling. And he basically was indicted, and he had to pay a small fine and do some community service, I believe. Yeah, but some certain concerns about integrity. Now, interestingly, is this going to be an integrity issue that we're going to put a lot of emphasis on as auditors? Probably not, because this is not necessarily a financial reporting. Now, keep in mind, what does this represent with respect to fraud? We're going to talk about the fraud risk factors next week. Does anybody remember that triangle from AIS? The fraud risk triangle? So pressure, rationalization, what was the other one that I'm not talking about? I guess I already gave you the one I was talking about. Pressure, opportunity, rationalization, okay? Could gambling habit represent one of those fraud risk factors? It'd be a pressure, okay, if he needs extra money. So that's something to keep an eye on. But what do you guys think? Did this one just kind of tweak you saying, all right, this is it. We're not going to deal with any gamblers? No, I think that was a small one. I did have you make some research on it, but we did find something. But for the most part, we're kind of like, you know what, this is not as big a deal as you might think. All right. So here's the question then. Here's the question. The question that we'll do is, should Wilson Adams retain EWC as an audit client for the current year? What do you guys think? I'm not going to raise hands because basically every time I raise hands, basically I have some people are very confident, and some people are like, yeah. But just kind of a general thoughts. Do people kind of think that this would be a good client to audit? If I'm an auditor, I would love to audit this client. if these are the only problems I can deal with, I can work with this, okay? There seems to be very high levels of management integrity. There seems to be some problems with management experience in one position, but in a lot of companies, you got management experience in a lot of positions, okay? A lot of people don't know what they were doing. There seems to be a lot of direction here. They understand what they're doing. They've got a competitive industry, but they've been in business for so long, they probably are aware of that and have proper controls to deal with it, okay? The AIS system is something we want to keep in our mind, but that was last year's problem. It appears that we've got that mostly worked out. These are definitely risks that we want to keep in mind moving forward, and I want you all to keep these in mind as we work through this semester. But if I have this chance to take this audit, I'm jumping on it, okay? I'm jumping on it. This is a great audit client. I will tell you right now, for those of you who go into auditing, it is unlikely you will find this clean an audit client in the real world. If you do, tell me about it. I want to do a case study, okay? It's just kind of amazing how little there is wrong with this. Now, that's not to say that if it's something that's worse than this, that you have to be questionable about this. Again, our goal here is not to say whether or not this is something that's overly taxing. There are definitely going to be problems with any client that you have. It's just the nature of it, especially if you have a large client. The question is that can we manage those risks? And if you're going to be somebody who's accepting engagement, your biggest concern is that if there's a problem with the engagement, are you going to be liable? Are you held liable for it? None of these risks really jump out at me as something that I can't manage. Now, there are going to be scenarios where we say we wouldn't want to go into this engagement, but for the most part, if we kind of keep in mind that auditing is a business, we need clients in order to make money, we're going to accept some level of risk. That's just the nature of it. That goes by the idea with reasonable assurance. So hopefully we keep this in mind, and it's good that we are accepting this as a new audit client, because if we had not accepted this as an audit client, I have no more work papers to provide for you guys, because this is actually the client we're going to be working on the rest of the semester. So it's kind of a foregone conclusion that we're going to be doing it, but logically speaking, you should be happy with this as an audit client. Now, if you came with the conclusion that there's risk here, I will agree that there's definitely risk with this, but there's going to be risk in any client. We do need to be able to manage the risk and not necessarily say we accept no risk. That's probably a little bit too far. So the good news is we have our audit client. We know what we're going to be doing moving forward. So we've got some assignments that are going to be due, or an assignment that's due on Friday for your homework. That is our next endeavor. So I will see you all then. Have a wonderful day.